Hello and welcome to Decode, a podcast series from SBI Mutual Fund. I'm Ruchi Mehta from the investments team. On Decode, we hope to have a heart-to-heart conversation with our fund managers, understand how they work, and manage their fund strategies. With me today, I have my colleague Ruchi Mehta, co-fund manager of the SBI Equity Savings Fund. Welcome, Ruchi.
Thanks, Rohit.
So I've seen you around in the company for about 7 years and a few more years before that. So tell us a little about yourself.
Well, thanks, Rohit, for having me on Decode. Yes, we've been colleagues for now 7+ years, and I've been part of the industry for now nearly 14 years. This is something that I really enjoy doing, which is research and fund management. Apart from this, I do like to travel a little bit and read, particularly stuff like history and financial markets.
So great. So what is the Equity Savings Fund exactly?
The Equity Savings Fund, or ESF for short, is a hybrid fund with investment in equities, fixed income securities and arbitrage positions. At a simplistic level, this is a fund which is kind of like a monthly income plan, but has equity taxation due to its portfolio having at least 65% in equities or equity related instruments. There are some key differences, mainly the equity exposure, which is higher than an MIP and therefore the risk is higher. If one looks at the MF product landscape for hybrid funds, you have at the lower end of the risk profile the MIP schemes with 15 or 25% equity exposure, and on the higher side the balance category, which has 65 to 75% equity exposure. The ESF category is designed to sit in the middle of these two ends. An ESF fund will have at least 65% invested between direct equities and arbitrage. This gives it the equity taxation benefits. Having the equity component split between arbitrage and direct equities helps reduce the risk profile of the fund. This is on account of the arbitrage investment being low risk, as it is unhedged, and earns a return typically around what cash would earn.
Well, thanks for clarifying that. It's always been a bit confusing to me about the hybrid funds landscape, particularly with the MIP, what's ESF and what's balanced. So can you tell us how exactly does the SBI Equity Savings Fund get managed?
Yes, there is a lot of jargon out there and it can get confusing. So let me try and simplify the fund. The SBIMF ESF fund is structured to allow us to invest between 65 and 90% in equities and equity related assets, and the remaining in fixed income and cash equivalents. However, within these constraints, we manage the product as follows. So we invest up to 70% into equities and equity related assets and 30% in fixed income assets. The equity component has a 20% that gets invested into a diversified equity portfolio, 20% gets invested into arbitrage securities, and the rest 30% gets invested between equity and arbitrage based on our internally developed asset allocation model.
Oh, so do you mean that you buy and sell the diversified portfolio?
Not really. To help reduce transaction cost and risk, we buy and sell the Nifty index, which is unique in this category. This flexibility, which is driven by an in-house developed model, helps provide dynamism to the fund to take advantage of market conditions to either increase or reduce equity exposure.
So could you tell us a little about each of these components? Let's start with the 20% direct equities. So what kind of portfolio do you expect to construct here? Are there any constraints or fund philosophy or preferences, sectors, market cap mix that you target?
The 20% equity portfolio is constructed as a diversified portfolio of 20 to 30 stocks. The objective is to have a concentrated portfolio of high conviction ideas across sectors and the market cap curve. We do have internal template constraints such as how much to overweight or underweight a sector. Given the constraints, the philosophy of the fund is to look for mispricing in stock valuations. A mispricing can be on account of factors such as growth being underappreciated or being questioned, or the valuations not in sync with the fundamentals of a company. With this, the idea is to build a bottoms-up portfolio. There is no sector or market cap preference. The allocation is therefore an outcome of the portfolio constructed.
So how about the other parts of the fixed component? That's the fixed income and arbitrage. How do you construct these?
The arbitrage portion is simply a portfolio of stocks which is hedged using futures. The objective of doing so is to earn returns equivalent to cash, which is effectively plus or minus the repo rate, but provide the equity taxation benefits to the overall portfolio. The fixed income portfolio is quite actively managed by the fixed income manager, my colleague Dinesh Ahuja. Dinesh constructs a portfolio with a primary focus on accrual. A part of the fund would also be invested in below AA minus rated assets with a minimum of A minus. Active duration strategies on the basis of asset allocation model would be taken for enhancement of the overall return of the fund.
And can you explain the flexible portion? This seems to be a key differentiator for our fund versus others in the market. So why has this specifically been chosen as that?
Well, I'll answer the second part of the question first, as in some senses it answers the entire question. We as a fund house believe we are better served by focusing our energies on stock picking rather than market timing. So, for a product like the ESF, where it's prudent to modulate the equity exposure, the approach taken was to have an internally developed and backtested quantitative model to guide the equity allocation rather than rely on pure human, therefore mine, ability to time the market. This quant-driven approach is what we believe differentiates us from the peers. The model used is one used for our dynamic asset allocation fund. It follows three principles to decide an allocation between equity and cash stroke arbitrage holdings: momentum, rate of change in momentum, and exhaustion of momentum. To help reduce the risk profile a notch further, we invest only in the cash nifty index for the flexible portion. We think that this unique approach differentiates our product from peers, primarily as a manner which attempts to capture equity upside and look at reducing aggregate risks.
Great. So what should be the time horizon for an investor in the fund?
Ideally, I think an investor with a 3 to 5 year time horizon for this fund should consider this fund, as it is inherently an equity oriented product and there will be high levels of risk compared to say an MIP or another fixed income product that's there.
Great. Thank you, Ruchit. Really nice to have you on the program. Thank you all for listening to Decode and see you soon.
Thanks, Rohit. Thank you for having me on Decode.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.